Thank you for the introduction. Um, Let me begin by a little bit about myself. I right after I joined IIT Bombay, I realized that I'm surrounded by too many talented people who are going to be far better engineers than me, and very soon I realized I should go into a field which is different than engineering, and I can still use my skills well. So that's when I started exploring finance as an option, and value investing is something that really connected with me. So I've been in the market since 2012. Started with a small token amount, and that even over time it grew. Well, I got more money to manage at a personal level, just my family's money, and over time it turned into a big sum. So, small caps as an asset class. Small caps was not something that I actively targeted at. When I started value investing, I was not looking at market cap as a restriction, but I was not looking at it as an opportunity as well. I never thought that I was not actively looking for investing in small caps. It's just that I found value in small caps, and that is why I ended up in investing in a number of small cap companies, which turned out to be decent investments. And people started asking me like, how did you go about it? So, as an asset class, when you look at passive investments, right? If you're looking to invest in equities, I would say small caps are obviously the most risky asset class, because if in terms of volatility, at least I can say that small caps have the highest volatility, and large caps are relatively lower, and mid caps are in the middle. But I wouldn't, say that just because an asset class is more volatile, neither is it an indication of it being of higher risk. Neither it is, and neither should one assume that just because something is more risky, it is going to make you more money. I mean, both those statements are wrong. What one must think as a value investor is always to do your work in the best possible way. The reason why people find more opportunities in small caps, and many time there are many active managers in India who have been able to beat the BSE small cap, or and of course the Nifty, for good periods of time. And the reason for that is, um, you know whenever a person learns value investing and becomes good at it, they want to move from small. They start with small caps because they find opportunities over there, but over time, as a fund manager performs well, they have a problem of size. Like, even if you look at Warren Buffett, the type of returns that he was generating in his initial years were not as great as more towards the recent past. And that's exactly the problem of size. When a fund manager has a big sum of money to manage, it is he does not spend his time looking at smaller companies, because even if he finds a good opportunity, he may not be able to deploy a sufficient part of his fund into that particular company, probably. And that's why they start looking at companies with higher market caps, and this creates opportunity space in small caps. Now, when I'm making these statements, I must also share a small disclaimer that anything that happens in this event, I will not talk anything about specific stocks, and none of my statements should be considered as investment advisors. Okay, so just a small disclaimer. And okay, so maybe I can start by going into specifics of small caps. Uh, Ganesh, is there anything that you want me to cover before I start that?
No, you can kind of proceed at your own pace as per your plan as such.
Okay, sure, sure, sure. Okay, so okay, let's look at value investing in small caps. So the general rules of investing are very straightforward. The first rule is always never to listen to experts. Well, never is a strong word, but certainly don't take anyone's advice as on the face of it. So in the small cap space, you will find many people who will come and tell you to buy a stock, and you just because you will always find that there are many companies whose price actions are not clearly justifiable. You will see that some are going up, some are going down, and you are not really sure what's driving that price movement. And the problem is this happens not only with the bad companies, but it also happens with the good companies. So when you are a small cap investor, be ready to face volatility, and don't be opportunistic in nature. Like, don't think that you will make money within a day or within a month or even probably within a year. It's probably that you buy. It will probably happen that you buy a stock today, and 1 month down the line you will realize it's 40% down. Another 1 month down the line you will realize it's a further 20% down. And the only reason why you will stick to your investment is because you have done the hard work and seen value in that particular company. And so it's not about being short sighted or anything. It's about how much you have invested, how much of time you have invested, how much of resources you have invested, what have been your efforts towards finding an investment. And that is basically what builds your conviction, and that is something that will help you remain invested in a good company over long periods of time. So that is point number one. uh, Point number two, I would say, you know small caps are pretty infamous. There have been instances, there are always shell companies in the market who are publicly listed. You will also find companies which are just which are doing something else and are projecting themselves to be something else. The way to find separate the wheat from the chaff is really difficult. And you can only do as much work as and has made it a significant part of his portfolio. It's very easy to develop a bias. You will, even though you are looking at data that goes against the thesis that you have developed, you will ignore it. That's just human nature. That it's a kind of bias. And yeah, I learned it the hard way. So I would suggest that no matter how convinced you are about an investment, never invest more than 20% of your portfolio, or even less. I would say 15%, more than 15% of your portfolio, of your small cap allocation, shouldn't be invested in a single company, no matter how convinced you are. And at the same time, I wouldn't say that you invest in 100 different companies or 50 different companies, because when you are a value investor, you have to keep in mind that you are investing in a business, and it is just practically impossible to do a good job on 20 companies, 20 different companies, 30 different companies. It is difficult to do that. I'm not saying it's impossible. There are people out there who do that. And even it depends on the risk appetite that different people have, on how much money you want to allocate to small caps itself. Like, I would never say that you sell your house and invest in this particular company. And that is true for even blue chip companies. Like, don't mortgage your house, raise capital, and invest in the stock market. That is something you should never do. And small caps should never, small caps can be 100% of your equity allocation. That is which where I can say that you will find enough data points to judge whether a company is good or bad. First is obviously related party transactions. These are it is all these are mandated by SEBI and other regulated authorities, that companies have to disclose certain things in their annual report. Related party transactions can be really helpful. If the total value of related party transactions is more than required, you have to look at it as a red flag and try to investigate why that happened. The good thing that has developed in the Indian markets, which I don't think so was as present 7 years back when I joined the markets, is that general public like you and me, we can actually dial in into conference calls of companies. So when you're doing your research and you have questions on your, there are some things that are not clear to you, you can always dial in and ask the management during a conference call. And many companies do it on a quarterly basis, some do it on a half yearly basis. But I think most of the good companies do it at least once in a year. Like if a company is not doing even that much, I think they just don't care whether minority shareholders are getting the data they want. So I mean, it is important that you look at the interest of the minority shareholders as well. So yeah, one is related party transactions. Second would be contingent liabilities. Loans guaranteed by the company for other financial bodies or other related parties, or maybe a subsidiary. Be sure to go through the list of contingent liabilities in the annual report. And the third place is loans and advances, which is a part of the balance sheet as well. So loans and advances is something that a company is supposed to give to other businesses. It is not supposed to, lend it to another company. The idea is, if there is a entry that you're making on your balance sheet in loans and advances, it should be for a business purpose. For example, if it is a chemical company, I would expect all the loans and advances to be given to some or the other chemical company, either a raw material supplier or probably another kind of vendor. Okay. I would pause for any questions if anyone has at this stage. Maybe I'm going a little too fast, so just want to make sure everyone is online. Sure, yeah, contingent liabilities are liabilities which are guaranteed by a particular company. So, for example, I shouldn't be naming companies, but let's say there is a group company. Um, uh, you know, let's say I start a company, and it's a part of let's say I belong to a big family, okay, a big wealthy family, and there is someone over me who is taking guarantees for me. So if I'm starting a company and I go to a bank to take some loans, people are not the bank is not going to give me a loan. He said, see, you are asking for 100 crore loan, all you have is like 5 lakhs of your net worth. How can you ask for a 100 crore rupee loan? Then I'll say that this guy, he's my friend, he belongs to this big group of companies, and yeah, if I default, this guy is always there to pay you, and that guy will kind of as such, but it will never be seen on a balance sheet. So that is what a contingent liability is. Sure. Related party transactions. So like with contingent liabilities, you can also have so related party transactions are those transactions which happen with related parties. Okay, that was that didn't make sense. When you're running a business, you have a number of raw material suppliers, right? And you can buy from anyone, but you will choose to buy from someone who is of your acquaintance. So for example, if my cousin owns let's say if I want to make a particular chemical and my cousin owns the raw material supply for that chemical, I will just buy raw materials from him. Even if someone else is selling that raw material at a cheaper cost, I will still go and buy from my brother. Now this is of one way where I could have saved money and created more value for my shareholders. Now if you want to take it one stage ahead, I would say I will buy things from my brother which are not even required by the business. That is one way of using my shareholders' money and giving it to another company, which is run by my brother. So that is how you can siphon out money from a company through related parties into someone else. Cool. So, uh, if these small cap companies, can be can be one of the many companies that the promoter family actually controls. So in India, as you know, promoters are not a single person. A promoter is always a family. So you should always remember that. And anyone within a family having ownership in other companies should be considered as part of the main company as well. So for example, if I'm saying that um, if I'm saying that I'm the sole owner of a particular company, that can never be true, because a fam when Indian rich Indian families, they will always look at all the companies in their plethora, in their umbrella. So the thing is, when one company is doing well and it is, and these are times when having a board, if you know that there is a mutual fund who is having a board seat in the company, or a private equity player, a big private equity player who again takes a part in the board seat, and not just that, they also help the management to make the business model a stronger one. It can be a big plus. And if a company is if such a company is trading cheaply, you have to do your research really well, because clearly, uh, if you know that there is a big private equity player who is really bullish on a company, other people are going to look at it as well. And if that stock is still trading cheap, and you're finding it attractive, there is a good chance that you have missed out on your research. You're missing out on some point which is giving you the notion that that particular stock is trading cheaply. Move on. So yeah, when you are looking for value in the small cap space, a company is a small cap for two reasons. Either because they are owning a small part of a big market, or because they're owning a big part of a small market. So both things are not bad. Like, but these are just two categories, and there are ways to analyze companies. There are slight differences and slight similarities in analyzing companies in both the categories. So I'll start with companies which have a big portion of a small pie. So these are generally companies who are sitting on something valuable. So there are a number of chemical companies in India who are making such chemicals whose total demand in the world is really small, and they control like 50 to 60% of the entire market all over the world. These companies are having a market cap of like 2000 or even 1000 crores. And what the reason why I like these kind of companies, these kind of business models, is because this particular chemical that the company is making, it is pretty much irreplaceable for a final product. Let's say it can be a FMCG product, it can be a, let's say, a tire, or it can be an automobile. They are making this product. They are the largest manufacturer of this product, and there is no further growth opportunities in this field. So you will not find competitors actively coming into the field and trying to manufacture that particular chemical. So insoluble sulfur, for example, it is a chemical which is required in like mls in a tire, and it is a very growing market in India. It will it in That particular chemical uh, makes the rubber of a tire more strong, and that is something required by um, that is something required when a tire is being made in a radial fashion rather than a bias tire fashion. Now, these are technical terms. The reason why I know these bias tire fashion. Now, these are technical terms. The reason why I know these terms is because I did my research and tried to understand where insoluble sulfur is actually being used. So maybe like I can you can independently search for these words and try to understand how insoluble sulfur is making a market for itself. And I was able to find a company which controls like 60% of the market within India, and at a global level it is a small player. It's the downside is very little. I have already done my work. I have understood that the company management is clean, they are not up to anything shady, and they are available on conference calls. I've asked my doubts, I've clarified from them. I've looked at their track record. They have shown decent growth in both revenues and profits with expanding margins. There are capex plans in place. So there are too many positives, and the business model remains strong. If this company falls during a bear market, a bear market where it is difficult to raise capital from banks, but this particular company has zero debt, and it is not really dependent on debt to do their capex, despite being a manufacturing company. And if this company, is available to me at a price to earnings ratio of 7 or 8, I mean, it's like a gold mine. When the market becomes euphoric, this company can trade at a price to earnings of 20, 25, and not to mention that it will probably, and these companies don't have to be profitable. The traditional concepts of value investing, which um, helps basically intends to say that a company should be priced cheaply, should be cash making, but this second category of small caps, they don't follow those kind of principles, and yet they can be good investments. So it is not something I'm an expert at or have actively invested in. That's why I don't want to comment much on it. But what I would say is that going forward, I see, you know just because a company is loss making, it won't mean that it cannot be listed. And in India you will rarely find that loss making companies are able to demand good multiples or a good price in the market. That is the Indian markets. But if you move in the developed world, you will find many loss making companies, or break companies which are just breaking even, to trade at really high multiples. And that is a different investment approach actually, so which I'm not an expert at, so I don't want to comment much on it. And yeah, I hope that is everything from my end. Any